All right, guys, welcome back. Let's get into the charts. Stock market technical analysis called this sell-off perfectly. So go back and watch my last two videos. You'll see exactly what I was looking at, how I was able to read the market and anticipate this sell-off that we're getting now. So just for anybody that says the trend is your friend, well, then that uptrend is not your friend today, that's for sure. And you want to make sure that you're looking at other things besides just riding a trend. All right, riding a trend is fine, but when you start to see signs that trend is going to reverse or has been broken, then the trend is no longer there. So the reality is that the trend in triple Qs right here on the chart was broke right back here on April 30th, or could have been April, somewhere right in here. Again, this trend line could have been adjusted. I've shown that, but either way, it was broke right in this area. The trend, there's no other trend that you could have drawn out that wasn't broke right here. So the trend was broke right here, and that was the signal that said, okay, we're no longer bullish. This rally is over or will end soon. And then what we got was this kickback rally right here, and this was the final kickback rally that you'll see sometimes. But it was on low volume. The volume was gone, and I kept pointing it out to everyone that down here we saw impulsive moves higher, and we saw volume. If I go to the daily chart, it's clear to see that. You can see, we had a lot higher volume, and we had big gaps. Like, look at that gap right there. And then every single time we tagged support, we gapped off it and ran up with more volume. And it was more impulsive. Then we got to this point, this kickback rally, after the uptrend was broken, and we were just grinding higher on low volume. And also right here, the rally started to lose steam. You could see that once we hit support, let me go back to the hourly just to show you guys. You can see once we hit support in this last little bit right here, we were just kind of grinding along support, no longer just gapping higher and then impulsively shooting up. We were just grinding along support. So that's something that you watch for to signal that you're losing momentum to the upside. Then we broke the trend. So now, this was the initial sign that, okay, we're starting to lose momentum. Then we actually lost momentum by breaking the trend. And then we had a grinding kickback rally on super low volume. And that was, I saw all those things, I noticed that, and then the final tell that I was able to read was this gap. We entered the gap on triple Qs on extremely low, not extremely low, but low volume, and low especially for entering such a major gap level. It was just, to me it was pretty obvious that this was not, there was no major institutional participation. And sure enough, and I kept saying in the past videos, go back and watch my last two videos, you'll see. But I kept saying, I don't think we're going to fill the gap. I think this is going to do a fake out, make it look like it wants to fill, but not fill. And sure enough, that's what has happened as of right now. So we didn't fill the gap. We fell short. Sellers stepped in, and they're smashing it down pretty good today. So here's your levels. 214.50 is your next level of support for the triple Qs, and so that is an important one to watch. And then SPY, we've got, let's see where support is. You probably have some support right here around 278. Maybe that's where we stop today, and then obviously down here at 271, 272, somewhere right in there. And that's the bottom of this sideways trading range. So we could easily come down and tag the bottom of this range and then move higher. Again, the other thing is, even though this trend has been broken, and we broke the trend right here, on SPY, here's where the momentum faded, kickback rally. We could come down, tag support, and then have another kickback rally. That's completely possible. That's what we did all of 2019. If I go to the daily chart, I'll roll out. And again, this is how I was able to call the top on the market too. It's just trend lines. You got to just kind of be able to understand trend lines and then be able to read that price activity around those trend lines. So here's the daily chart. Here's the 2009 bottom of the Great Recession, and here is your uptrend line that I've pointed out. I'm just covering it for anybody that's new, but basically you can see that held support, held support, held support, and then as we roll over, you can see held support in here. Then we broke back in 2018, and that's when I started saying, that's when this channel basically flipped bearish. And all of 2019 was a kickback rally underneath. Kickback, kickback, and then here's the, we kicked all the way back to it, and that's when I started putting out the videos like saying, basically, this is the top of the market. That's the video that I called out and said that I think this is the top of the market. And that was the only video where I essentially called a top. I put out one video saying it's the top of the market, and sure enough, boom, big impulsive breakdown. So that's the start of your bear market. And the thing is that in this bear market, you have to realize that because it's been such a long bull market, a lot of traders that are trading and investing in this in the stock market today have never experienced a bear market, so they're not going to be able to, they don't know what to look for, and they just don't know how to be able to read the signs, and so that's why their mantra is basically buy the dip, and what they do, you'll see it. What they do is typically, when they experience big losses, big downdrafts, they kind of dig in their heels and say, well, this doesn't affect me because I'm investing for the long term. And that's fine. I understand the concept of investing for the long term, and I do that too. But just because we've had, just because the market has bounced back in the last, really if I go to like a monthly chart, I want to point this out. Just because the market has bounced back in the .com bust here and in the Great Recession, it had a huge rally here, does not mean we're going to just have a little pullback and then the market just bounces back and marches on to new all-time highs. Each one of these rallies, you do have to understand, they were created by the Federal Reserve. Alan Greenspan started this credit bubble basically when he started reducing interest rates and using, Paul Volcker jacked the interest rates up to like 20% back in the 70s. And then Alan Greenspan, when he took over at the Federal Reserve, he had high interest rates that he was able to ease and cut. And we've been in that large cycle from all the way back from the late 1970s till now. We've been dropping interest rates to zero. Well, now we've hit zero, and we have hit crazy money printing now too. So they don't have rates anymore. Now they're trying to go to money printing. So it's kind of at the end of the road in terms of what they can do to keep popping the market up. That's what each one of these rallies right here was created from. That's why we had the Great Recession here, because they dropped interest rates. You got a housing bubble basically on cheap money. It's when you have lower interest rates, people take out more than they probably should. So then you get the Great Recession, and then that's all that, that's what a lot of this is. It's a corporate debt bubble basically is what we had. We had low interest rates, corporations selling corporate debt, taking the money and buying back their shares, and the stock market, went higher. So now, the thing is, when you're listening to younger people, and I'm not that old, but I did live through the Great Recession, and I was a kid during the .com one, but basically, when you have people that have only experienced really this, they look back and say, look, the stock market always comes back, because that's what their parents told them. And that's because their parents really, baby boomers really started investing in the 1980s, and all they really experienced was a bull market, induced by the Federal Reserve. So the baby boomers have been, the financial advisors and the baby boomers have always understood, okay, when markets crash, you buy it, and they come back in 2 to 3 years and make their way higher, and you're good. Well, that's happened, but that doesn't mean it has to happen. Okay, that could change in the future. And what I'm saying is, we might experience a bear market that crashes and doesn't just bounce right back. Maybe it goes sideways for 20 years. Maybe it slowly comes back, but doesn't ever get back to the all-time highs for 30 years. This is what happened in Japan. Look at the Nikkei, look at the historical Nikkei chart, and they had a very similar setup to what we have going on here. So it's just a possibility. United States stock markets are not immune to the realities of the gravity of economics. All right, economics are universal, they're not specific. We don't have some different thing going on here in the U.S. It's a market, we're an economy, and that. So that's what I want to cover there. So anyway, so that's what I say about those. Let's look at some other charts here. XLV, look, just going sideways, heading back down to support, clean and clear support right there. So this thing's been just crystal clear. I mean, it's not necessary. It trades pretty well, actually, but so what are we going to do? Well, we're going to probably hit support. I think we're going to gap lower at some point, but maybe we hit support, grind around it, then we gap lower or have an impulsive move lower. XLF, very weak. The banks look extremely weak. And I kept saying that, without the XLF, without the banks and the financials rallying, you're not going to see much. It's hard for the markets to move higher. And that's exactly what we're seeing today. The financials are continuing to look very weak. And now tech is looking weak as well. So just everything looks weak, basically. Let's look at Walmart. This one, and I'm just showing these ones because these are trades that I've called out, and I have trades on these. Short Walmart. Look, we ran up into support or into resistance, overshot it a little bit. They tried to do a little fake out move. You like to see that when you have a trend line, it validates your trend line. When you have an overshoot and then it fails and recaptures back below that trend line, that validates that trend line. So we've got a lot of reactions around this trend line validating it. It's pretty crystal clear resistance at this point. And usually by the time the market realizes something is, a trend line is valid, it's done with that. So I think we head lower now, down to 117.91. So I'll take profit a little bit above that. And that's the first target right there. I might put out some different targets. I mean, if you look at the daily chart, you can make the big bearish rising wedge. So we can easily come to the bottom of the wedge. This is just the first profit target. I'll probably take a little bit off there. And then, let me extend this out. We could easily get down to about $100, $110, somewhere right in there on Walmart. SOXX, look, bearish rising wedge on the hourly chart, breakdown, back test, failure. So this big bearish rising wedge pattern is a bearish pattern. When you can make these patterns, they signal that, yes, even though price is moving higher, momentum is starting to wane, and you're not able to, it's coiling. You see how it starts wide here and gets skinnier and skinnier? So ultimately what you do is one way to do it is you take the widest part of the wedge, which is basically here, I suppose, something like that. And then you do something like this. When you break down, that's like a measured target. That's kind of how, I'm sorry, let me actually move that. You got to move it up to there. So the measured target for this pattern would be right about down to here at 212. And that's just a measured target. So that's one way to kind of put a rough estimate into where this thing's going. And then I like to look at levels, support levels, and just watch it break those support levels. So you've got in SOXX, you've clearly got a level right there because we held support right there. So that's probably the target. We'll probably get there today. And maybe tomorrow, but the selling's pretty impulsive today. So, and then we'll have to watch it, see where our next levels are at. Probably, it looks like we got one right down here, right there. There's another level, and that is sitting there at 215. Again, these levels aren't exact. What you want to do is think of it like a range. When you start approaching a level, watch the price action. Does it come down and break? Does it undercut it and then recover? Does it cut right through it and not recover? Things like that give you the idea of what's going to happen. Usually what you'll see, especially when you have pretty impulsive selling, is you'll run down to a level, you'll undercut it, make it look like it's not going to hold support, and then you'll recover that level. And that tells you that, okay, we held support here. We're probably going to have some sort of a reaction, a gap higher, or a move higher, or something like that, before maybe you continue the downtrend. So that's something to watch for. TVIX, people want me to point this out, so I'm long this one. Probably looking to take some profit here pretty soon because it's been a monster trade so far. I mean, from the lows of yesterday, the thing's up 55%. But look, here's an hourly chart. Here's your trend line. All right, so you could mark this out pretty. You know, I could spot this pretty cleanly, but you've got reaction, 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 and look what happened yesterday. This is what I'm talking about when you undercut. See, yesterday or 2 days ago, sorry, we undercut it, and then it recovered, and it recovered yesterday, and that was a sign that okay, that's a false breakdown. You'll see these a lot in stocks because what happens is institutions need liquidity. They need activity. They need people selling their shares. If they want to buy shares, they need a lot of people selling those shares in order to buy the shares that they want to buy without moving the price up. If they buy just at support and they plow a bunch of money in, they start moving the price up and they can't get a good fill. But if they undercut levels, it creates stop losses. Stops get ran. People's stop losses get ran automatically selling, and they buy into that selling. And so that's what you're seeing here. I don't know if institutions trade this, but that's what that is doing. So now we're shooting up. So sure enough, you know, we're going higher. I think 250. Let's see. You know, it's probably about. Looks like there's a level right around in there. So let's see here. That's probably a good profit target right there, at least the first one. I'll probably be taking my profit up around that level, and I'll exit the trade. I'm not expecting this TVIX to just shoot up to the highs like this. Just because the market's crashing or making another leg down in a bear market doesn't mean that this just makes a new higher high. This can just, you can have, what I do on the TVIX is when you start to get a inflection point in the markets, traders are caught off sides. And so if they're long and all of a sudden you get this bearish bear trap or a bull trap and stocks start selling off, everybody scrambles all at once to reposition, either get short or sell their longs and take profit. It's a mad scramble, and you'll see that impulsive selling day, a real nasty red candle, and that's when I sell. You know, I sell my TVIX on those impulsive moves. That's how I trade it, and obviously TVIX can go a lot higher, but I prefer to just capture that initial reaction. It's a higher probability trade in my mind. Okay, moving on. I'll just keep going down the list of what I'm looking at. These are the things that tell me how, you know, I use these stocks. It gives me an idea of where the market's going. JP Morgan, look at that, super weak. I mean, you had a bear, you know, here's your first leg down. Here's your, you know, it's basically a big bear flag. All right, it's basically like a big bear flag. That's not an accurate trend line. I'm just trying to highlight that it's a big flag, and we've resolved to the downside. So that tells me that this trend is going to continue in JP Morgan, and that's a big player in the financials. Apple, first impulsive sell breakdown of this trend line. Here's the trend line. Close this. Here's the trend line from the lows, and here's your bear market rally potentially. Apple, you know, shot way up there, and you can see we were riding that reaction low. Didn't quite get one there, but lots of reactions along the trend line right here. Started to get a little sloppy in here. We had a couple false breakdowns, but still reaction, reaction, reaction. And here's that price action that I look for when you're just grinding along a trend line. You're not able to impulsively move off of it. You just are grinding along that trend line. Let's look at the volume and how that looked like during that time. No, the volume wasn't super low. So that wasn't necessarily a tell in Apple, but the grinding action, and then we, you know, started to lift off of it, and then, you know, we're selling down. So pretty impulsive candle. You can see that's a pretty clean breakdown right there in that trend line. If this candle sticks, of course, the hour's not over, but it'll be over here in 3 minutes. So that's your first, you know, that's a pretty impulsive breakdown right there in Apple. So just something to keep an eye on. And that's really all I got for this video. The miners, gold miners, are selling off a little bit too, so I'm kind of watching those. I'll put out a separate gold miner video when the charts start to firm up, maybe at the end of the day or tomorrow or something. But the point is, we're getting breakdowns in the market. This could be, and it doesn't have to be, but here's the NASDAQ futures, but it could be the start of the next leg down in a bigger bear market. And if this is the next leg down, this is usually the sharpest and most impulsive leg down. They call it the C leg, and there's the potential. A lot of people are talking about double bottoms, things like that. There's the potential that there is no double bottom. There is a move to lower lows. Another impulsive leg down. And we'll break the lows and continue lower, basically. There is the potential for that. So does not mean it has to happen. We could even, this could have been the low. We might just fall down to this 203. Major support here on triple Qs at 203.50. And so that is an area I'll be watching to see what happens here. But there is the potential to break that. I think we'll probably chop around here for a little while at least. But there is the potential to break lower. So keep that in mind when the charts get down to important levels. We'll need to watch that to gather more information, try to figure out what's going on. Thanks, guys.